What are dark pools in stock trading? Imagine you are watching a busy marketplace where most transactions happen in the open, but some deals are made behind closed doors. That's similar to how dark pools work in the stock market. Dark pools are private spaces where big investors buy and sell large amounts of stocks or other securities without showing their hand to everyone. Unlike public stock exchanges like the New York Stock Exchange, where all orders are visible, dark pools keep these large trades hidden until they are completed. Most of the time, institutional investors such as mutual funds, pension funds, and hedge funds use dark pools. They want to buy or sell big blocks of stocks without causing the price to jump up or down before the trade is finished. If they placed a large order on a public exchange, the market might see it and react, making the price move unfavorably. Dark pools help avoid this by keeping the size and price of the order secret until the trade is done. Here is how it works. When a large trade is planned, it is matched privately between buyers and sellers, often through brokers. The price is agreed upon in this private setting, not on the open market. The trade then gets reported after it is completed, so the public only sees the final result. There are different types of dark pools, including those run by broker-dealers for their clients, agency dark pools that do not set prices themselves, and electronic market makers that facilitate these trades. For someone learning about investing and stock market basics, understanding dark pools is helpful because they show how some big trades happen differently than the usual buying and selling you see with regular stock quotes. Retail investors, or everyday people like you and me, mostly trade on public exchanges where prices and volumes are clear. Dark pools operate behind the scenes and can influence overall market liquidity and prices indirectly. However, dark pools also raise questions about transparency and fairness. Since orders are hidden, regular investors cannot see the full supply and demand before trades happen. This can sometimes put retail traders at a disadvantage because they don't have the same information. Some studies suggest that dark pools might reduce market efficiency because they fragment trading activity away from public markets. As a student investor, you probably won't trade directly in dark pools because they are mainly used by large institutional investors. But knowing about them helps you understand why stock prices sometimes move in ways that don't seem to match the news or visible orders. Large investors use these private venues to make big trades quietly, which can impact the overall market in subtle ways. In summary, dark pools are private trading spaces where big investors buy and sell large amounts of stocks without revealing details beforehand. They are a part of the modern stock market structure that operates alongside public exchanges. While they serve a purpose for large trades, they also bring up questions about transparency and fairness in trading. Understanding dark pools gives you a clearer picture of how the stock market functions beyond what you see in stock quotes every day.